Come on, yes, my people. Shout out to the block because we're back with another episode of Blocks to Bags, and we're joined by a very special guest. We're joined by our boy Mickey. How you doing today?
Yes, Sab. All good. How you doing?
All good. And we've got our resident South London fintech and finance expert over here, and we're going to be doing a very special episode today called The Money Matrix. Yes. The
Big.
Money Matrix. Come on. And let me just talk a little bit about what kind of inspired this kind of segment now. Me and Mickey, we've been boys for a while. And how many documentaries have we seen on the economic crisis? Yeah?
Way too many.
Come on. And we were talking last night about a very interesting thing where we were live and direct when the 2008/2010 financial crisis happened. And I think that was the point where we got really into like the financial system, breaking it down, like what's actually going on. What is the central bank? What is quantitative easing? What's fractional reserve banking? All of these terms was brazy. What we thought we would do is we thought we would distill 10 plus years of knowledge and docs on finance, the economy, for the mandem, for the block.
Yes. Let's do it, bro.
Let's do it. So I think the first topic that we want to talk about is inflation. This is a big one. We've been living in the age of hyperinflation. What do we mean when we actually say inflation? Let's break it down for the block.
But so inflation essentially is the cost of goods, right?
Yeah.
Rising over a period of time. So we've seen it in London right now, right? Just a simple example, yesterday, Seb, you came over to mine, we were having dinner, right? We went to get some sparkling water. A couple of months ago, that sparkling water was £1.25.
Yeah.
Yesterday, when we bought it, was £1.59. So the price of that good, aka the sparkling water, has gone up. So that is really what inflation is, right? The cost of goods rising over time.
Got it. And very interesting fact is, does inflation happen because the cost of producing these goods go higher? Or I wanted to chat something else. Is it because there's more money in the kind of system we're printing off money? Like people talk about printing money's being printed by the central bank. Does that relate to inflation, or what's the vibe?
Yeah, I think obviously inflation is the fundamental reason you get inflation is to do with the money supply.
Yeah.
So essentially,
Let's talk about it.
inflation means when there's a lot of money, right, the available money to go towards the resources increase. So that drives up the prices of goods, right? So when you have a lot of money in the system,
Yeah.
that money has to go somewhere.
So what do you mean by a lot of money in this? Who is the system? Who the hell is the system, and where is this money coming from?
All right, so here is the thing. I personally would like to not define myself as a conspiracy theorist. But all I'm going to say is the system is insane. And the system starts really at what we call the central bank.
Let's talk about it.
I believe the central bank is probably the most authoritarian institution in the world. And people don't know about it.
Yeah, we're talking more authoritarian than the army. We're talking
Way
more
more,
authoritarian
way
than the police.
Way more.
How deep does it go?
Deeper, because at the end of the day, the army is responsive to someone, right? Government, whatever you might call it. Same with the feds. But the thing with central banks is they actually are not responsible to anyone. They are not governed by anyone. It is a really weird dynamic they exist in. They are both independent of government and yet have to act in the interest of a country, or they are the ones who drive that country's economic policies. And now, why I say they are really authoritarian is so historically, right?
Yeah.
There is a distinction between how central banks operate and how governments operate. So central banks, really, their purpose is to determine what is known as monetary policy.
Yeah.
Basically, the cash, the paper that goes around, what we call money, is determined in terms of how it flows through our system, how much there is, and how much stability financially there is determined by central banks, right? So a central bank can create money out of thin air.
Yeah, and quick question. When we talk about the central banks, who are the big boys, the big players?
Obviously, the central bank of the central bank is the Federal Reserve.
Oh, there's a central
and the
bank
Federal Reserve
of the
is
central
a madness.
bank.
Oh my days! It is actually a
The
madness.
Fed.
The Fed. It's a weird bank. There's a number of banks that comprise to make the central bank. So there's the central bank.
So we're saying the central bank of America, the Federal Reserve, is made of
Multiple
other
banks.
private banks.
Multiple.
And these are this is the central bank is what controls the monetary policy of the United States.
United States.
Same with the UK. We've got the Bank of England and stuff like that. But we're saying this institution is actually made of private banks within itself.
Yeah, so you've got like the New York Central Bank, or the New York Federal Reserve, the Kansas City Federal Reserve, and so on and so on. And there's a number of these, and each of these has a governor. And they are what you might think of as like an executive body, right? A group of people who collectively decide monetary policy. And why monetary policy? What we mean is the way in which money is conducted through our system, the way it's produced, it's the way it's directed. So think about it. Recently, one thing we've seen a lot about is interest rates. Right?
Yes.
So that's one of the primary policy tools central banks use to determine how much money there is in a system. So right now, for example, we've got a lot of inflation.
Tell me about it.
When we've got that hella inflation, obviously it creates a lot of issues. Cost of goods going up creates a cost of living crisis for normal consumers because they are on typically fixed wages.
Okay.
Right? So then it starts creating some elements of financial and social instability.
Okay.
One of the primary purposes of a central bank is to make sure there is that level of stability. So what a central bank will do is they raise the interest rates
to fight.
What does that mean to raise the interest rates? It basically means they make it more expensive for what are known as primary dealers, aka the secondary level.
We ain't talking about your local shotters either, you know what I'm saying?
So in the US, for example, we've got about 25 primary dealers. JP Morgan, all of these big boy banks, right? They're known as prime. And here's the madness. These men have their own private accounts with the Federal Reserve.
Mad.
Alright, so now these guys get money from the Federal Reserve regularly. They borrow money, right?
Yeah.
Now, if the Federal Reserve wants to increase the interest rates, what they do is they make it more expensive for the man to borrow money.
Got it.
Now, when that money becomes more expensive, it means there is less demand for money, right? So, for example, if I tell you I could borrow you £100, you know, and you pay me 1%, seems pretty attractive. If I tell you
give that to
you have to pay me, you know, 100%, you're going to be less inclined to want it, right? So then what does that do? That reduces the money supply. So then that supposedly can rein in inflation.
Got it.
Now here's the maddest thing about this.
What's the mad thing? Right? Drop the mad thing on us.
All right. So a central bank can literally, if they want to increase the money supply, the way it works is insane. So say in recent years, right, we've had low interest rates. Right?
Very low.
Right. When you buy a house, last 15 years before 2020, interest rates were about 2-3%.
Yeah.
Mad, right? Now, that means there's a lot of money in the system. What the central bank will do to increase money is it will go to JP Morgan and it will say to it, all right, we are trying to increase the money. You can buy government bonds from us.
Yeah.
But that money doesn't exist. The central bank doesn't have the money. It's not a money that exists. So what they do is they just go on their little computers.
Yeah.
And they've got their accounts for JP Morgan and they'll be like, all right, here's $8 billion.
Okay, so what we're saying is these men are literally typing on computers and creating billions and billions of dollars out of thin air to go into the system.
Stop you right there, bro.
Go on.
It's not billions.
What is it?
It's trillions.
Oh my gosh.
So here is the thing. Before 2008, the Federal Reserve, it was created pre-1920s, around that time. It had created about $1 trillion worth of money.
What, so from like the 1920s to 2008 kind of time,
80 years-ish, right? 90 years. Then from 2008, by 2010, that balance sheet had gone to above 2.2 trillion. So they doubled how much money they created out.
In 80 years, they printed the same amount of money in just 2 years after the financial crisis.
All right, so where do we stand right now with that number? above $7 trillion, bro.
Damn. And what does this mean for the everyday person? Go on, break it down
Alright,
for the
so
block. What does this mean for the block?
I'm sorry to say this, but you're fucked.
Whew.
I'm sorry to have to come in like that, but here is the thing. All right, when that money is created, where does it go to?
Businesses, people, what banks? I don't know. Where does it go to?
Right, so here is the thing about inflation. You've got two primary types of inflation.
Yeah.
The shit that we're struggling with right now is known as price inflation. The cost of goods going up, right? Because there's more money competing for those goods.
Yeah.
Right? That hurts all of us.
Yeah.
But then the thing that hurts us even more is what's known as asset price inflation.
Okay, let's talk asset price
asset
inflation.
price inflation doesn't hurt all of us. It hurts people that don't have assets.
Okay.
And people who are on incomes, but does not hurt and benefits people who have assets, right? So, for example, if you've bought a house in 2010, let's say,
yeah,
that house might be worth 300 grand.
Yeah.
Today, that house is probably worth around 600 grand. Now, during that time, the Federal Reserve, the Bank of England, right? They be telling you inflation has been below 2%.
Yeah.
Right? Because the cost of your Coca-Cola has not really changed that much over those 10 years. But that house has gone up by 100%.
That's actually mad.
How many people have yards?
How
many people have yards though?
Not, I don't know. It depends.
Very few people.
It depends. Very
so
few.
If you don't have assets, you're effed.
So it's very important to make a distinction between asset-based inflation and kind of cost-based inflation, price-based inflation, and it's mad. Actually, it's mad. So there was a very interesting comment that you made earlier around wage stagnation.
Exactly, yeah.
And I wanted to kind of go into that a little bit deeper. So when we look at wages and we look at inflation, I've been seeing a couple stats and metrics which show that I think since the 1970s, people's wages have basically been gradually like decreasing, even though people are kind of getting paid more. Like someone in the 1970s, like the average salary in like the 1970s or 80s was like 10 grand or 12 grand. Now the average salary is like 28 grand in London or 30 grand or somewhere around that. So people are kind of getting paid more on the outside,
nominally.
But are they actually getting paid more? Like, what's really going on? Because it looks like our people are struggling, man. It looks like life was actually a bit easier back then. People were able to buy houses. People were able to start families in their 20s, so on and so forth. So, like, what's really going on?
That's the biggest madness, right? Like, that's what, like, so if you've seen a lot of the strikes right now, the way that they're portrayed is when they're talking about it, is they talk about real-time wage loss, right?
Yeah.
So that means, as you said, like, let's say, you know, in the 70s, average income might have been 10K, let's say. Now, let's say it's 30K, right?
Yeah.
You think it's gone up, what?
3x.
Yeah, 3x. But it's not really, because, let's say, at that time in the 70s, the cost of our house was maybe 10 bags as well. But now it's what? Average is 300.
So it's gone up by 30x basically.
So then actually your money, nominally, why I say nominally is the numbers look more, but what it can buy you is significantly less. So you have wage stagnation. And so actually there's a really sick book. It is dense and it's hella long. It is hella long by this French don called Thomas Piketty. Right?
Okay, you're dropping a real gem here. If you want to go deep, you know where to look.
Yeah, and bro, in this book, basically, what he actually highlights is this growing inequality in society, and it's precisely because of these reasons, right? Wages have not kept up with inflation, but asset prices have gone up significantly more. So what that means is, if you had a yard, let's say in the 1970s, 80s, or whatever, you bought a yard for 10K, 20K, right? I literally have people who are, you know, family friends, right?
Yeah.
Who bought yards in the 90s really cheap in Dulwich or some shit.
Yeah.
Right? Now those same people are now they got peas.
Yeah, billionaires, M's, they're up.
Up big time for doing nothing because that asset has gone up in price significantly. Yeah. So then that drives mad inequality.
That's mad. So from what we've been talking about how inflation is killing our people. The system is set up so people from sort of poorer backgrounds or who don't have access to these money and assets are going to stay losing. So, Mickey, my bro, what kind of advice do we have for the block, for the people, for the mandem? Like, how do you beat inflation? Like, what can you kind of do in today's day and age to make sure that you're staying on point and that you're not falling into the money matrix?
Yeah, I think, you know what, it is... The way I would think about it is not necessarily about how to necessarily beat inflation, right? But how do you make sure that economically and financially, you yourself are as resilient as possible to all of these mad shocks.
Resilience.
Right? So obviously one is the way in which you hold your assets. I'm talking about assets as in any cash you might have, any investments you might have, right? How you distribute them. So for instance, if you've got a large amount of cash or any money, right?
Yeah.
As much as possible, you should try hold that in investments, various types of investments.
What are we talking about? Investments like stocks and shares, houses, gold. What?
Obviously, there is obviously, if you depends on your level, right?
Yeah.
If you only have 10k in cash, you're not going to be able to invest that in a yard really properly.
Okay.
Right? I mean, there is ways you might do that, but what I'd say is, you want to first of all have a diversified set of revenue investments.
Yeah.
Equities, aka what stocks and
shares,
all of these, right? They are quite high risk, but they are long term, right? They could return huge amounts of returns for you. But then you've got other types of assets which typically are able to beat not necessarily always inflation,
Okay.
but they will return way more assets to you, way more returns than say a savings account, right?
Okay, cool.
So government bonds,
okay.
right? In the UK, they're known as guilds. In the
Okay.
US, they're known as like treasury notes.
And how much percent return do
These
we
can
have
give
on
you up
those
to
government?
3-4% right now for
Okay.
some.
And that kind of makes sense if the inflation so how does that make sense if the inflation rate is at like 10%, 11%, 12%, or like what kind of investments or things can we look at that will help us keep in line with inflation? Do you know what I'm saying?
Yeah, obviously the key is assets, right?
Assets.
As we said, right? Asset prices, the rate of increase in asset prices outstrips the rate of increase in say wages you might have,
Yeah.
but also in the returns you get at a bank. So back like the last 15 years, right? If you had money in a savings account in a bank, usually the bank, you don't get interest rate. You actually pay to put your money in the bank. Do you know that, right?
Mm-hmm.
So if interest rate is, let's say, inflation is 2%, right? And you put 10k in there, right? And you get 0% in return on the cash you've held, you've lost 2% over that 10 years. So you have literally paid the bank to hold your money. Right? So you need to find various you have to find places to put your money that will give you a return. So government bonds, for example, they are super safe. The US government,
low risk but low reward in a way.
Low risk but fairly decent reward because for example, right, like right now, right, when you work in VC, right?
Yeah.
We see what's going on in VC. Funding has been decimated.
Dried up.
Why? Because if you've got, say, a bill, right?
Yeah.
Instead of just going and giving it to VCs and all of these, you could just put it in government treasuries, right? That will give you guaranteed 4-5% a year.
Yeah.
Calm. You don't need to risk your money. So then that reduces the appetite for VC, right? Likewise, government bonds, etc. Because you know why? The US government ain't going to ever default on its loans.
You never know.
But if it defaults, then it's calm because really the world is done at that point.
Out there, yeah.
So that's why it's as safe an asset as possible. But then you want to also, have a diversified portfolio.
Yeah.
So you want to invest in things like
stocks and shares,
crypto,
maybe not.
Government bonds. I think some level of high risk investment in.
What about
like
commodities?
crypto.
I've heard commodities
are great.
Right now.
Commodities are sometimes, there you have to be careful with commodities. People have been saying gold, but really, if you look at the price of gold, it's not gone up that much in the last few years. But if you had to say in the 1970s, right, if you had 10 bags and you instead of putting in the bank, you bought a bar of gold or whatever, right, that would have gone up significantly by now because the price of gold has kept up with the price of inflation.
Facts.
So there are ways to beat inflation, but you can't think of it in short-term returns. You can't think of it in like, okay, this year I'm going to make my 10%. But you've got to have a diversified portfolio. You've got to be aware of the way in which, your money travels through the system and where you can get the best returns for it.
I love that. Come on. That has been your money matrix breakdown. We've spoken about central banks. We've spoken about inflation. We've spoken about some of the strategies to kind of fight inflation. Thank you for coming through, Mickey. This was a sick episode. If you like
Thanks for having me, bro.
Come on. If you like this episode, drop us some likes and comments down below. We'll get Mickey back on. We'll continue the money matrix. Let's go, my people.